Let's get to Rick Santelli in Chicago looking at monetary policy and markets. Hey, Rick.
Yeah, we're going to do some battle here. Brian battle. All right, you know, off camera, we were actually having a bit of a battle, but it seems like we ended up on the same side.
I think so.
Here's what I want to get at. I have a lot of discussions. I'm the go-to guy when people want to say that the Fed's programs are good. I'm the guy they put up there. I always take the other side because I believe it. And really, I think the only argument that I see that the other side, people like Fed policy, current policy, QE, is that, you said there'd be all in inflation. You're wrong, wrong, wrong. I go back to the tapes, and I've been very careful. It's not an inflation issue.
Right.
I'd call it a commodity issue. We're going to create commodity volatility. Have Fed programs, the Qs, the twists, currently, have they not created a bit of commodity inflation over the last handful of years?
Right. Depends on the definition of inflation. What is a commodity? Is there what thing has gone up a lot in value recently? The stock market. Maybe that's where inflation is. And inflation just isn't price inflation or wage inflation. It's a cash chasing an asset. So you could argue that there's too many dollars chasing too few goods, and the stock market has rallied, and that's where you see the inflation.
You know, the other thing I've been very careful to say is inflation, it's baked in the cake. But nobody's going to get a taste of it till things are good. And see, this is, I think, the biggest problem with any exit. When things are good, interest rates are going to be going up anyway if there were no Fed programs.
Right.
Add in the exit, add in that all these MIT models were accurate. They created all these trillions of dollars, but they weren't accurate about human behavior.
Right. Economics is human behavior. Exactly right. So we have a massive stock of money in the economy, but there's no V. There's NV equals PY. There's no velocity. There's
no velocity.
Flow.
So where does money go? Financial assets?
Right. Financial assets, and it's parked in the giant banks. Look at the trading reports for the giant banks. They make money every day. They've got a giant carry trade on. You can't lose. So if the intent was to stimulate the economy, they missed. The transmission mechanism is broken. You can't flood money in the system, expect to lower rates, increase business success, increase employment, therefore the economy gets better. That's a long way from monetary policy. That tool is inappropriate to cause growth in the economy.
Now, Mr. Volcker has, right when all of this was going on, the fall of '08, he was very
Volcker, yes.
Boy, try to say that 10 times.
He said the Fed was operating on the very edge of legality.
Exactly,
yes.
Exactly. What is he saying today?
Paul Volcker said, well, you got to be careful with your reputation because it takes a long time to build it up, and credibility is a hard thing to get. He said, if you think that you can cause a little bit of inflation and cause a little bit more and then turn the wheels down and not get it back, he said, good luck with that, was his exact quote. And I take what Paul Volcker says with full face value because he's the last Fed chairman that actually had to do the hard job and raise rates.
Excellent. I'll tell you, Brian, it was a good battle, and I want you to come back because I think Abenomics is going to give us many more chapter battles regarding money and inflation at some point down the road. Back to you.